don't skip this video. Very important video. Let's assume that you have 50,000 rupees per month extra that is ready to be used, and you have 4 options in front of you. Option number 1 is that you put this 50,000 rupees per month in stock market SIP. Option number 2 is use this 50,000 rupees per month to buy gold every single month. Option number 3 is that you take a loan. With that loan, you buy a land and you put this 50,000 rupees per month for clearing out that loan in the next few years. And option number 4 is that you already have a home loan going on. You want to use this 50,000 rupees per month to pay off that home loan early. Out of these 4 options, which option would you go for? I'm going to give you 3 seconds to make your decision. 3, 2, 1. If you made your decision, let me know in the comments. It's very important you write down your option in the comments. Generally, whatever decisions we make in first impression, few seconds, they are biased by something called as primacy bias. And generally decisions made using primacy bias go horribly wrong. In this video, I'm going to break down how to think about these 4 options, because there are hundreds of variables here and this is very tricky decision. It is not an easy decision to be made at all. If you're new to my channel, my name is Rahul Jain. Hit that subscribe button now, because you're going to learn a lot in the next 15 to 17 minutes. With that, let's get this video cracking. For me to be able to make this decision, there are 2 factors. Factor number 1 is how much wealth I am likely to make in each of these options, let's say 20 years down the line. Okay. And number 2 is what will my next 20 years look like in terms of my experience, because in each of these options, there will be problems coming my way in the next 20 years, because 20 years is such a long period of time. Keeping these 2 factors in mind, I'm going to make my decision. So let me run you through each of these options in detail. Option number 1, which is we putting this extra 50,000 rupees per month in the stock market SIP. Now, stock market is a very vast area. You could do SIPs in stocks, in active mutual funds, in index mutual funds, in ETFs, in Indian stock market, in global stock markets. There are a hell lot of options. I'm going to simplify this and take 4 to 5 simple examples. Option number 1 is I do my SIP in large cap in Indian stock market. Nifty 100 is the benchmark. And if we look at the last 20 years of SIP performance of Nifty 100, the returns we have got is around 13.16% CAGR basis annual returns, and 1 crore 20 lakhs of SIPs we would have done in the next 20 years, and that 1 crore 20 lakhs would become around 5 crore 30 lakhs. I've used last 20 years of return data because I don't know what the future will look like. In all the 4 options, I am going to forecast my returns or my wealth based on the last 20 years. And that is like for like comparison in all the 4 options, because we do not know. In fact, nobody knows what will happen in the next 20 years. So coming back to Nifty 100, I've taken last 20 years of SIP returns, which is around 13.16% CAGR basis, and my investment, which is 50,000 rupees per month, done over next 20 years, comes out to be 1 crore 20 lakh is my principal amount, and my growth will be around 5 crore 30 lakh rupees. That is what the wealth I'm going to make if I do large cap. Okay. Now the other variation could be that you don't want to go for large cap, you want to go for mid cap. And if you follow me, you would know that I've been saying it for a number of years that mid cap offers the best opportunity in terms of the growth at a less volatility as compared to small cap. Of course, they go through some cycles, but generally if you look at mid cap performance in the same period, last 20 years, exactly the same dates, the SIP performance of mid cap 150 index has been around 17.52% CAGR basis. Same 1 crore 20 lakhs would have become 9 crore 7 lakhs looking at last 20 years of data. Again, no guarantee that mid caps will continue to perform for the next 20 years exactly how they have done in the past 20 years. But past is telling me something that I'm using as my basis to compare. Okay. Third option here is that we use small cap 250 index benchmark. Here the CAGR return has been around 14.9%. 1 crore 20 lakhs would actually grow to around 6 crore 56 lakh rupees. Okay. And the next one is Nifty 500. If you are going to put your money on Nifty 500, what will happen? This 1 crore 20 lakhs could become 5 crore 61 lakhs, assuming 13.63% of CAGR returns, which Nifty 500 have delivered already in the last 20 years or so. Okay. Now comes the US stock market as well. Let's put that in the mix as well. S&P 500 in INR terms, very important. INR terms meaning that we have taken care of the currency depreciation as well here. Okay. It comes out to be around 15.55% of CAGR returns. 1 crore 20 lakhs could have become 7 crore 11 lakh rupees if we put it into S&P 500. Now here is the quick summary of all the 5 options that we have considered here. Large cap 100, mid cap 150, small cap 250, Nifty 500, S&P 500. And you can clearly see mid cap in the last 20 years have delivered the best returns, 9 crore 7 lakhs in this calculation. And then S&P 500 at number 2, 7 crore 11 lakhs, and at third is small cap 250 at 6 crore 56 lakhs. So if we assume that past 20 returns could give us the same returns in the future, then this is the kind of wealth we are likely to make. Now, equity investing, there are some pros and cons as well. Let me quickly walk you through what is the upside from an experience perspective and what is the downside from an experience perspective, because these are hard numbers, but we have to qualify these numbers. Okay. So what are the upsides when we invest in SIPs in stock market? Point number 1 is that your probability of making returns from stock market over 20 years is high. Why? Because stock market is predictable. Stocks go up. Why? Because their earning per share goes up. Right? And earning per share goes up. Why? Because economy grows. So if we think that Indian economy is likely to grow because we're still a developing country, and if we become developed country 20 years down the line, that is a chance that stock market will go because the economy will grow. So predictability of the returns in stock market is very high actually over 20 years of time period. In the short term, it can correct 20%, 30%, 40%, but that is a good thing about stock market because it is driven by the EPS growth rate. Okay. Point number 2, good thing about stock market SIPs is that it is a very liquid option. If you want to stop your SIPs after 5 years, 8 years, 10 years, you want to take all your money out because maybe you want to use this money for some other purpose, for your daughter or son's education or for whatever reason, some emergency comes, it's a very, very liquid option. Sell it off, come out. You don't need to find buyers. Stock market is a very, very good place where you can just sell off, dump your stuff and comes out. Third is that you are not taking a lot of risk here because you're making a portfolio. Okay. You're not relying on one company. You're not relying on one particular thing. Okay. Therefore, in my view, the risk is very, very limited. And number 4 is the chances of fraud is very limited in stock market because it's highly regulated. SEBI has done a tremendous job in the last few decades. Even if you compare with US stock market, I would say Indian stock market is much more regulated. I know there are fraud instances here and there, but overall, if you look at it, very, very highly regulated. Fraud chances are less here. Having said this, there are 2 big downsides of investing in equity market. Number 1 is the volatility, short-term volatility. All of a sudden, portfolios come down by 30%, 40%. We have seen that in the last few years, right? So to remain invested and continue to do 50,000 rupees per month SIP is very, very hard practically. Okay. And point number 2 is that you see your prices almost on a daily basis. Forget about daily basis. You see them on a second basis. And when that happens, you have an itch. You have an itch to sell. Because if all of a sudden a stock or an index fund or a mutual fund has given you 20% upside, what are you likely to do? You might just sell off. Okay, because you made good money, you want to come out. Remain invested for 20 years is a problem in stock market because you see the prices live. You see it on your mobile almost on a daily basis, right? So these are the upsides and downside of the option 1. And these are the practicalities. Let me now walk you through the next 3 options as well in the very, very similar fashion so that towards the end, we can actually evaluate all these 4 options and conclude something that I would like to tell you from my perspective. So far, if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. And don't forget to subscribe to this channel because hopefully you're learning new every single day. Okay, with that, let's go to option number 2 now. Option number 2 is buying gold every single month using 50,000 rupees per month. Be it physical gold, ETFs, mutual funds, that is your choice. Doesn't really matter much. Now, here is some past data for you. Exactly same time period I've taken, and I've taken domestic prices of gold. I've removed all the nonsense about, duties, etc. Domestic prices of gold in India, same time period, last 20 years, CAGR returns comes out to be around 15.11%. To my surprise, actually gold has done pretty well, mainly because last 1 year or so, it is almost doubled, more than double, right? The entire rally has come in just 1 year, if you see, okay? So because of 15.11% of CAGR returns in the last 20 years, 1 crore 20 lakhs could have become how much? 6 crore 73 lakhs. Not bad at all in the last 20 years. Right? Now, this is from hard numbers perspective, but qualitatively, let me tell you upside and downside as we discussed for SIPs. So from an upside perspective, number 1 is that probability of making returns in gold is also high. Why? Because gold is recognized globally. It is considered as a store of value, not just by Indians, actually across the world, right? Given what is happening right now geopolitically, there is no trust in the countries. Gold becomes more and more valuable as we go along in the future. Second upside is liquidity of gold. Much like SIPs, gold is also a very liquid option. You can sell it anytime and come out of gold. There are enough buyers, be it ETFs or even physically. You go to any store, you can sell it anytime. In fact, not just in India. You can actually carry it with you globally anywhere and you sell it off. This is a global currency. Liquidity is a very, very good option in gold as well. Now coming to the fraud, chances of fraud in gold are very, very less because, for example, if you're using gold ETFs, gold mutual funds, highly regulated. And even if you're taking physical gold, nowadays government has made sure there are hallmarks and you go to some reputed jeweler, you're not going to get scammed. Okay. Chances are very, very less unless you're really, really making big mistakes, which I'm hoping you're not making those mistakes, right? Now, from a downside perspective, gold is also very, very volatile, much like SIPs in stock market. You will see gold correcting by 20%, 15%. It is entirely possible. We have seen gold correction as well. And point number 2 is that there is a long period of not giving much returns in gold. That also happens. For 10 years period, 12 years period, it may not beat FD returns as well. And all of a sudden in 1 year, 2 year, 3 year, the rally will break out. Okay. So the nature of the gold is that you really have to be very calm about it. Okay. One point I forgot about the upside of the gold is that potentially once you buy the gold, you're not checking the prices as you're checking the stocks or mutual funds, hopefully, because you just buy it. And generally I've seen Indians do not really offload their gold very, very easily. They keep it for generations, keep it for daughters and grandchildren as well, right? So that way you can remain invested in gold. There is no problem with that. The only problem is that there may be a substantial number of times of period where it is not giving you more than FD returns, 3%, 4%. And then you might think, yeah, what have I done here? Okay. So this is about gold. Second option, not a bad option at all. I'll talk about it in terms of ranking it as well. But let's go to option number 3. Coming to option number 3, taking a loan and with that loan amount buying a plot or a piece of land and then start paying the EMIs, 50,000 rupees per month. Now, in order for me to be able to buy a land, let's say I'm going to take a loan of around 60 lakh rupees because I've done some maths here. If I take a loan of 60 lakh rupees at 8% interest for the next 20 years, my EMIs come out to be around 50,000 rupees per month. Now, I've not included all other costs like registration costs, stamp duty, etc. because I'm not interested in that. I'm going to talk about the basic concepts here. Okay. So 50,000 rupees per month, I've taken a loan of 60 lakh rupees. And with that 60 lakh rupees, I've bought a piece of land. Again, you might ask me, Rahul, 60,000 mein, what will I get? I understand. I've bought a piece of land recently around 43 lakhs. It is possible. Maybe, smaller towns outside this outskirt of the big cities, you will be able to find a land. It's not that you can't find it. Okay. But let's not go into those details, whether you can afford 60 lakh rupees land or not. That is beyond the scope of this video. Okay. Now, the trickiest question here is that how much the plot can appreciate by in the next 20 years. And I've looked onto internet and I've spent 2 days trying to find out some credible source of data and I couldn't conclude anything. Why? Because let me run you through a few scenarios here. For example, this study was done. This study takes care of around 30 years of data that is available, wherever it is available. And the conclusion was that house prices in India have gone up by around 9.3% CAGR basis over 30 years of time period. Okay, this is one source of data that we can consider. Right? But more importantly, if I looked at, for example, Delhi circle rates, okay, you would note that from 2011 onwards, they've almost gone up by 4 times, from 2,15,000 to almost 7,75,000. Of course, there has been a period of no revision at all in circle rate versus going up very, very high. Okay, this is around Delhi. If you go to, for example, Kolkata, again, very vague figure here, 2 to 10% CAGR basis of appreciation in prices depending on the locality. Because as I said, there are thousands of variables. If you look at Chennai and Tamil Nadu, south of our India, then around 5.6% of CAGR. Again, depends on a lot of things. Somebody might have got 20% CAGR, somebody might have got only 2% CAGR. That is also a possibility, right? If you look at Mumbai, again, around 5 to 8% of CAGR basis returns. Again, as I said, there are hundreds of variables here. And then there are anecdotal situations like this one I found. This guy saying that he bought a farm or a land, 60 lakh rupees an acre. And in 10 years, it went to 10x. Maybe because the location he chose became multi-bagger for whatever reason. Some heavy development happened, some airport came or whatever happened there. These anecdotal situations are also there. I've heard that from many people that, oh, my land went up by 20x or 30x or whatever, right? That is also there. Now, how to look at these returns? I've considered 4 base scenarios. Number 1 is 4% CAGR basis appreciation in your property, meaning that every 18 years, your land price is double. Okay, very, very low return, abysmal return here. Your plot is going to be worth around 1 crore 31 lakhs after 20 years. Okay. Second scenario, 8% CAGR basis. Every 9 years, your property price is double almost. Okay. It comes out to be around 2 crore 79 lakh rupees. Third scenario, 12% CAGR basis. 6 years, your land price is double almost. 5 crore 78 lakhs will be the worth of your plot after 20 years. And 18% CAGR basis, which is every 4 years, your plot price is double. You will actually have your plot going up for 16 crore 43 lakhs. Not a bad money at all. It could be anything. That is my point here. Now let me run you through qualitative parameters of land, which is the most important part of this video. Okay. So from an upside perspective, I think that, and you also know that, the land supply is limited. God has stopped making more land. Okay. You will have more and more companies getting listed, right, on stock market. You will have more and more gold being digged or mined. But land, you can't make it. It is absolutely limited in supply, and therefore it is a store of value, not for 20 years. It could be the value for 200 years, for 2000 years. Your grandchildren ke bhi grandchildren ke bhi grandchildren could use that piece of land that you buy today. That is the beauty of buying land. There is no doubt about it. There is no question about it. Okay. Second good thing about land is that you do not see the prices of the land going up or down on a daily basis. That is the best thing about land. And that is why maximum people can remain invested in property, in land for 20 years without blinking the eye. Because they're not seeing the price. When they're not seeing the price, they're not getting affected. I bought a land 20 years back and it is still there. That is the story you will hear. But you will not hear a story that I got a Reliance stock 20 years back and I still hold it. Very, very few people will tell you about stocks like this, but they will tell you about properties that my great grandfather got this property, or my grandfather got this property, or my father got this property, or my mother got this property 20 years back. I still have it, right? These are the upside of the land. Now coming to the downside of the land, one of the biggest problem is that price appreciation is unpredictable. There is no EPS growth rate here. There is no globalization going on that will give price update for gold. So the return predictability is not there in the case of land. But the second big problem is that for the long period of time, the price of the property may not appreciate. The land may not appreciate. All of a sudden, something will happen in the nearby area because of which your land price will go like 10x or 5x or whatever, right? So that is also there in the land. And third is the chances of fraud in land is extremely high in India. I mean, what's going on in India? There is somebody or the other will come and try to do kabza on your plot. It is happening even now. Every single city, it is happening across India. And fourth one is, it is actually illiquid. If you want to sell it off and come out, you have to find a buyer. It's not very easy. It's not like SIPs, you can sell off anytime, come out. It's not like gold, you can sell off anytime, come out. You have to find a buyer. You have to make sure you get a good price, fair price of your land. This is the downside of the land. So I've given you this commentary so that you understand the nature of the asset. Okay. With that, let's go to option number 4. And then I'm going to rank all of these 4 options based on what I feel is my view. Guys, so far if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you and subscribe to my channel. I'm hoping that you're liking this content. Okay. With that, let's go to option number 4, which is that you already have a home loan going on. And using this 50,000 rupees per month, you want to just pay off that loan early so that you have a mental peace. Okay. So I've done some calculations. For example, you have already a home loan of 1 crore. You took it for 20 years at 8% interest rate. Okay. I'm going to make it very, very simple. And let's say you are paying 66,000 rupees of EMI already. The loan will go for 20 years. Let's say that it's going to finish at 2046. Okay. Now what you do here is that you start paying this 50,000 rupees prepayment after 2 or 3 years of time period. Again, I've made some assumptions here. I don't know what your situation might be. You might have already paid 10 years of loan, that I don't know. But I'm assuming that after 2 years, you start paying 50,000 rupees per month. What will happen with that? Your loan duration will come down from 20 years to, let's say, potentially 10 years. That's the assumption I've made here. You will clear your loan by 2035. Meaning that after 2035, for the next 10 years, the entire EMI that you were paying, which was 66,000 plus this 50,000 rupees per month, that 1,21,000 rupees now you have to invest or to do whatever you want to do, right? Because you've paid your loan early and that money gets unlocked now. You can do what you want to do with that. So now let's assume that you are putting this money in either gold or stock market. Those are the 2 options because you've paid your loan early, right? And the next 10 years, you are now investing. Okay, what will happen in that case? I've taken some calculations here. So for next 10 years, your 1,21,000 rupees of EMI could give you, again, in large cap, around 13.6% basis return, 2 crore 88 lakhs. Mid cap, 17.52% CAGR basis return, 3 crore 64 lakhs. Small cap, 14.9%, around 3 crore 16 lakhs. Nifty 500, 13.63% CAGR returns, 2 crore 95 lakhs. S&P 500, 15.55%, 3 crore 27 lakhs. And gold 15.11%, 3 crore 20 lakhs rupees. Now you might say that, Rahul, you've assumed same returns for 10 years. Yes, I've made some assumptions here. The same returns that we got for 20 years might not be valid for 20 years. There are a lot of assumptions here, right? The assumption here is also that you've taken 1 crore of loan. Okay, you might not have taken 1 crore loan. You might have taken 80 lakhs, 70 lakhs. So depending on your situation, you might have to think about it. But mota, what I'm trying to conclude here is that if you pay off your loan early, that is good. That is going to give you mental peace. And because you've made your payment early, the remaining loan period, you have that extra money, which is your initial EMI, original EMI plus 50,000 rupees per month, that can generate wealth for you, albeit for the lower number of years. Here 10 years I have assumed. Okay, but you can still make decent money, 2 crore, 3 crore here in these examples, right? Now, what is the upside of this option qualitatively, and what is the downside of this option qualitatively? So upside is very, very simple. Number one is the mental peace. You don't know what's going to happen in the world in the next 10 years. AI is coming, jobs might be lost. It's better to pay off your loan if you have the money. And you sleep very tight, very sound in the night. That is a big upside. And second upside is that you still make money, because you still invested that remaining money for 10 years and you still make decent money. It's not that you've not made money, right? But the downside is that, please understand, your 8% home loan is not costly at all. You could have made 12%, you could have made 15%. You are losing that opportunity to generate wealth over a longer period of time, because nowadays, you know what, stock market has become very easy because you have all the technology, you have all the information. You can use Claude, ChatGPT to do analysis on the stock. There are so many ways where you can generate wealth for yourself. By paying loan which was at 7-8%, you might have missed the opportunity. That is the downside. And the other downside is that you're not leaving a lot for your children, because your entire life is potentially going to pay off that loan. That is what you're bothered about. You might not leave a lot for your children or grandchildren. That also is a possibility here in the case of paying off your home loan. But the positive side is that you have that mental peace that, you know what, I've paid my loan. I'm free now. I can enjoy my life. I don't have any more debt. Okay, so these are the 4 options that I've gone through with you with some practicalities around it. Now, let me give you my view, because you know what, it's absolutely difficult to make this decision. It depends on your personal circumstances as well, right? But what is my view? Let me tell you in the next 1 to 2 minutes. So how to make this decision will entirely depend on one thing, which is what are you good at? Okay, it really depends on what you are good at. But in my view, if I were to make that decision for myself, this is how I would think for this decision. I would rank these 4 options in this order. First option I would go for is investing in equity. The reason I'm going to go with investing in equity is because it is the most predictable one. And secondly, it is a big ocean out there. The opportunities are huge if you know how to invest. Okay. And if you have not been following me, please hit that subscribe button now. I'm going to teach you how to go about investing your money in the next 6 months or so. If you watch my videos, you are going to learn a lot. I can promise you that. Okay, ask anybody who's been following me. They will tell you that the knowledge we have got in the last 1 year, 2 year, 3 year, 4 years, however number of years they've been following me, they will tell you that we have learned a lot from this guy. Okay, again, I'm not boasting here, but I'm simply telling you that I would any day go for equity, because I feel that I'm very good at equity versus any other option. So if you are good at equity, go with option 1. If you're not good at equity, maybe you're good in real estate, that's option number 2. Then go with real estate, but please make sure you also understand that real estate comes with problems like you need to be a thick-skinned person. Okay, you should be fine with corruption. You should be fine with fighting with people. You should be fine with going to courts. And most people who are going to the 9 to 5, 9 to 8 jobs, they're not good at it. They will buy a property, they will make a mess of it, they will create a headache for themselves. So do it only if you are good at real estate, you can really find good locations, and you are like Salman Khan, Dabang style person, okay, who can take on anybody, who can take on police, who can take on contractors, who can take on anybody. Okay, you're not afraid, you're a fearless guy, not afraid to fight. Then option 2 could be really good. If you don't understand equity, you don't understand real estate, can't take that much of risk, then third option, gold, is a no-brainer. Dimag nahi lagana is gold, in my view. Okay, 20 years continuously just put your money in gold, maybe that is a no-brainer option. Because you cannot time the gold prices, I can tell you that. There are a lot of theories about gold. It will go 3 lakh, 15 lakh, 20 lakh. I don't know. People can tell you a lot about gold. But please remember one thing, the gold's long-term trend is like this. Okay, it is never this. It is like this. It's a no-brainer asset. Our grandparents taught this. You don't need to go to school for this. Okay, no-brainer. And finally is the fourth one. If you really, really need mental peace, then go for paying off your loan. I'm not saying it's a bad option. It really depends on you entirely. Do you want to really sleep in the night peaceful without having any worry about the debt? If you feel that your job is at the edge, you might lose your job tomorrow, or you might not want to get into that trap of, you know what, will I have my job or not? Or your family circumstances are like that you're the only earning member. Your wife or your partner is not earning for whatever reasons, good or bad, whatever is the reason. In that case, that might be an option. It really, really depends on your thinking. I've told you honestly what I think. I'm going to go with option 1 if I were to make that decision for myself, because I know I'm very good at investing versus all other options. I cannot fight with people, right? I can't even argue with people, okay? Let alone fight. I can't even argue with people. That's not me. Of course, you can make a balanced allocation as well. I'm not saying you don't make an allocation here. You can make allocation to gold as well. You might go 25,000 rupees in gold, 25,000 in equity. You might say that I want to go with gold plus real estate. That is also a very sensible option. You might have a diversified portfolio, not denying that as well. But the intent of creating this video was what? Intent of creating this video is to give you the nature of the assets. One is the hard numbers which nobody can guarantee and predict and forecast. But the nature of the asset is what you need to understand, and you complement it with your own knowledge, your skill, your psychology, your emotions. What is your behavior? That is what should decide your investing decision, not what I am telling you, not what so and so is telling you that they've made so much of money. No, it is entirely on you to make the decision based on your own skills, based on your own behavior. That's all I would say. If you like this, hit that subscribe button now. I'm going to see you in the next one. Until then, keep rocking.